You spot a perfect double top on your 15-minute chart. You execute a sell order, set your stop loss above the peak, and wait. The price stalls, and a violent wick spikes upward. Your neon green stop loss zone is pierced by 3 pips, knocking you out. Immediately, the price crashes 50 pips in your intended direction. You predicted the move, but you were utilized as market liquidity. Large institutions like banks and hedge funds are constrained by physics. They deal in volumes so massive they cannot simply execute an order without shifting the price heavily against themselves. Looking at this zoomed-out chart, we see the mechanics at play. A cluster of retail stop losses above a double top acts as a concentrated pool of automated buy orders. This creates buy-side liquidity, thousands of buy orders waiting to be triggered, providing the exact counterparty liquidity the institution needs to fill its single massive sell block. To a professional algorithm, a retail stop loss is never a protective barrier. It is an open invitation for a fill. Institutional market movement follows a rigid chronological cycle designed to manufacture this exact liquidity. The daily sequence moves through accumulation, manipulation, and distribution. The accumulation phase typically occurs during the quiet Asian trading session. The market is kept in a tight range, building up unexecuted orders over several hours. During this period, the market prints minor fakeouts known as inducements. These small, tempting moves lure retail traders into entering positions early and placing their stop losses right above very obvious highs and lows. The manipulation phase triggers exactly as high-volume sessions, like London or New York, open for the day. This is the Judas swing, a violent, intentional market push designed to sweep through accumulated stop losses and engulf unprepared retail traders. That morning volatility is the deliberate execution of the trap. The sweep collects the required orders to fuel the true institutional position for the rest of the day. Once the institutional order is filled, the distribution phase begins. The real move kicks in, and it leaves distinct structural footprints on the chart. A standard break of structure simply confirms an ongoing trend. To identify when the big players are reversing the market, you must look for a change of character. This line graph maps a change of character. Price aggressively breaks the most recent major swing low, proving institutions are exiting. The massive volume required skips orders, leaving a fair value gap. Price then pulls back, rebalancing the gap before continuing its heavy drop. Recognizing that structural shift and waiting for the gap to rebalance is how you flip your strategy. You stop acting as liquidity and start hunting alongside the institution. Executing your trades alongside massive institutions requires entirely abandoning arbitrary profit targets and instead relying strictly on absolute structural logic. Aiming for a fixed 20 or 30 pips ignores the mechanics of the chart. Market geometry operates entirely independently of arbitrary retail numbers. You must set your profit targets at the next logical pool of retail stop losses. This is known as external range liquidity. This chart illustrates execution logic. Entering at the institutional gap's origin allows an incredibly tight stop loss of 5 to 10 pips, the tiny red risk box. Targeting the distant liquidity pool secures a 1 to 5 risk-to-reward ratio, requiring only a 25% win rate for profitability. Ultimately, the market is a pure mechanism, deliberately designed to seek out liquidity to facilitate massive institutional trade flow. You can utilize FXNX's zero-spread platforms to accurately map these liquidity zones and execute precisely on those institutional footprints. Download our Institutional Liquidity Map cheat sheet today and begin identifying your first fair value gaps immediately.